4 o'clock on Wall Street. Do you know where your money is? Hi, everybody. Welcome back to the closing bell. I'm Maria Bartiromo on the floor of the New York Stock Exchange. A rip-roaring rally once again. Second straight day after more good news on housing today to help the Dow erase Monday's massive losses. An inch closer again to a record high. All this without any help from Apple, which, by the way, was down nearly $4 a share. Take a look at how we're settling out tonight. On a Wednesday on Wall Street, the Dow Jones Industrial Average up 1.25%, 176 points higher on the Dow. 14,076 is where the index is closing out tonight. NASDAQ up 32 points. Technology and financials, the big winners on the session today. The NASDAQ at 3162. And the S&P 500 tonight up 19 points, 1.25% higher at 1516, indicating, yes, a very broad-based buying situation today. Let's get straight to the market action with Ed Butowsky from Chapwood Investments, Michael Yoshikami from Destination Wealth Management, Mark Eibel from Russell Investments, Josh Brown from Fusion Analytics, Gordon Charlotte from Rosenblatt Securities will join us in just a moment, who's been on the floor settling out his trades, and we're going to talk to him about the end of the day. Good to see everybody. Thanks for joining us. Michael Yoshikami, kick us off here. What do you think about this rally today? To what would you attribute the gains?
Yeah, it's a bit of short covering, Maria, but I think the economy is getting better. If you look at look at the home sales numbers as well as the durable good numbers, people, I think, are just way too negative still. Even though the market's rallied, I think what's starting to happen is that negative sentiment starting to turn. The individual investor is starting to get a bit of courage back, and I just think you're starting to see money pour into equities. Like we talked last time, I think you're finally going to see flows coming out of fixed income and in money market accounts back into equities, and I think that pushes the market higher.
Does everybody agree with that, Mike?
Not a chance in the world.
Go ahead. Take it. Ed, you said not a chance?
Yeah, I'll go ahead and take it. Absolutely not a chance in the world. I mean, the individual investor doesn't mean anything in this market anymore, with the exception of their 401k plans that they contribute to. The reason this market went higher is short covering, but along with that is Bernanke basically saying, hey, what I'm doing is working, it's helping. So what he really said, in a way, was, I'm going to keep doing this and doing it and doing it, and you don't fight the Fed. But don't think for a moment, everybody always says housing is getting better. Yes, it's getting better, but that's not the entire economy. The economy is in really bad shape, and the reason the market's going higher, don't forget it has nothing to do with the individual investor, it has to do with computer trading, and because the Fed is printing money.
Okay, but so what? I mean, we all know the reason that this market is rallying.
Yeah, that would have kept you.
It's going to go higher. It is absolutely going to go higher now, without question. It's going to go higher without question.
Let me just say,
I think it's Josh.
That's a stale thesis. That would have kept you out of the market for about 137% now. We
Guess
know
what?
that the Fed's
I've been fully invested. You're absolutely wrong about that. You attributed the market going higher to the individual investor, and that's not true.
I didn't.
The market's going higher. That's why.
Said that?
The market's going higher. I've been an investor in the market, but it's not because of the individual investor. That's just not true. 97% of the volume are computers and institutions.
No one's saying that the individual investor is driving this. What the argument is, here's the argument. It's not necessarily a great rotation yet. We've had $1 trillion in outflows from the investor, and the market has gone straight up. We know it's the Fed. Okay, that's an old, stale thesis. So now the question is, if behavior changes and animal spirits are actually here for the first time, and the wealth effect from housing actually is a beneficent sign for the stock market, the question is, can this continue? And I would say I'm not 100% convinced of that, but the signs look better than they did 6 months ago, a year ago.
Absolutely.
Mark,
I completely agree.
Jump in here, Mark. How do you see it, Mark?
Yeah, I would agree. I think it's primarily Fed-driven at this point, but I wouldn't undersell the individual, at least moving forward from here. I don't think it's a rotation out of fixed income. We haven't seen the spike in yields yet. I think this is cash coming off the table, maybe even a little bit of gold from people that bought it $1,800 or $1,900 an ounce, thinking it was going to $2,500. So I think it's a combination of everything. I'd put Fed at the top of that checklist. I think housing is part of it, consumer confidence is part of it, and a slight rotation that's starting to move out. So I think you add it all up, and I think it's there. But I would probably put the Fed at this point at the top of that checklist, but I think the individual is coming in, and it's just starting.
It seems like some of the most levered companies are actually the ones that are rising. You've got the most levered index up 2%. So is that a healthy market where the most leveraged stocks are actually the winners?
I just think that's a function of the fact that really large companies, which have been leading the market for years now, are able to finance at such cheap levels. I would have to look at what some of the top sectors are there, but I suspect you see some financial companies, and that's obviously a Fed story. We're essentially handing them a net interest margin on a silver platter when they could borrow for free and figure out different ways to lend. So I'm not sure if that's the best way to gauge whether or not the rally's healthy.
Get this.
Right,
I'm just getting this from S&P Capital IQ. The current 12-month forward price-to-earnings ratio for the S&P 500 is now less than where it was in October '07 when equities reached record high levels.
Absolutely.
So, Ed, you can talk all you want about the fact that this is a Bernanke rally and the fact that the Fed has created an environment where there are few alternatives. But at the end of the day, valuations are not excessive.
I've never said that valuations were excessive. What I said all along is that stocks are cheap. Stocks are actually 25% below where they should be. I just don't believe the fact that the individual investor is causing this, but I think stocks go substantially higher, especially if they break 14,300. I think we're going a lot higher in the overall market, without question.
But see what matters. And if you look at why the market's up, I mean, the Fed, it's obvious. The Fed is juicing the market. That's not the question. The question is not what happened. The question is what will happen. The Fed is already here. The bottom line is what are going to be the stimulus factors? The stimulus factors are individual investor, housing recovery, durable goods orders increasing, and emerging markets coming back. That is what's going to move the market higher. No one's disputing the Fed has juiced the market. The reality is stocks are likely cheap where they are right now. But as you correctly point out, Maria, so often we're in a very, very unhealthy situation right now where the market is in fact bid up by the Fed. If the Fed was put interest rates where quote unquote they should be, we wouldn't be at where we're at right now in the market.
Yeah, let me bring Gordon
I think
Charlotte
that last
in here.
point's a good one, though. I think
He's watching the flow. Gordon, what can you tell us at the end of the day? Was there a sell imbalance or a buy imbalance?
A little bit of a sell-off here, Maria. I mean, look, the market's been one way, but the thing that you have to be wondering about here is you look at the VIX in relation to the way the market's been behaving. Guys down here are really starting to sense that we may be seeing a near-term bull trap setting up here. I mean, up 200, down 200. Oh, it's only up 100 today. No big deal. So, I mean, guys are sitting here, and you know, it's just happening too easily, too quickly. Everybody who's behind on investing is saying, oh, I have to get in. But this isn't what makes a healthy market. This is what makes it go up. I mean, right now, what we have, the Italian bond auction went better than expected, so Europe is fine, and therefore...
Well, what about Spain's auction on the horizon in the next couple of weeks, right?
Well, we have that coming too, Maria. That's the whole point. So you have this little isolated episode. All of a sudden, Europe's problems are entirely behind them, and then you have like this euro-dollar thing going on. So the market loves currency wars because now you can buy it in the cheaper currency. So a lot of this just continues to be sort of, inflated by like external terms, macro terms that are sort of unrelated to earnings, the kind of things that you really want to talk about if you're going to see a strong move. We still don't have the volume we're looking for. The VIX down again today in a big way. I mean, it's too easy. It's just setting up badly, I think.
So are you telling me you want to sell into this rally?
At some point, you got to be prepared that this thing is going to turn around. You've got to be mindful of a correction. You got to start to be nimble here. If you're not, you're going to get hurt. But look, guys are sitting there saying, "Oh, you got to buy it. You got to buy it. I don't care. You know, this valuation is good. It's going up. I got cash in the sideline. It's all coming in." That's not what makes a healthy market. If the reason you're putting your money there is because there's no place else to put it, eventually you're going to start to see this thing turn around. And when it does, it's going to pick up speed. Yeah, we're going to see a correction here pretty soon.
Yeah, I mean, you'll.
I think there are also other places to put it, though.
When it does. Gentlemen, thank you. Go ahead. Final word there. Go ahead.
I think that point earlier made about emerging markets. Emerging markets are probably arguably the undervalued part of equities around the globe, and they have not participated in this. And international, I know it did well today outside the U.S., but they're still negative, at least for this month. So as far as maybe moving away from a market that maybe has gotten a little overheated in the short run, outside of the U.S. and emerging markets might be a good place to move to.
All right, we got to go. We got Byron Wien now to talk to us about what's going on. Gentlemen, thank you very much.